All right, diving into TransOcean's Q3 2024 earnings call. And I got to say, things are, well, they're a little murky. You've got, on the one hand, a company with a jam-packed schedule for 2025. They're pulling in some of the highest day rates we've seen, and there are signs that customers are in it for the long haul. But on the other hand, investors are, well, a bit skittish about what happens after this boom. So we're going to break down the key takeaways from the call and from some recent stock analysis. Hopefully, by the time we're done, you'll have a clearer picture of why TransOcean is causing such a stir in the offshore drilling world.
It's a real head-scratcher, isn't it? This contrast we're seeing. TransOcean's practically bragging about their nearly full fleet for 2025. And those day rates, wow, any competitor would kill for those. But then you look at their stock, down 35% since January, and you realize there's a whole lot of uncertainty baked into that picture.
So let's start with the good news. TransOcean's CEO, Jeremy Thigpen, he kicked off the call with some pretty impressive numbers. Their backlog is sitting at $9.3 billion. That's a jump of 7.5% from last quarter. They're also projecting 97% fleet utilization for 2025. And get this, some of their day rates are going above $500,000. And we're talking about projects that don't even start until 2025. By then, most of the industry is expecting to have a lot more downtime.
Yeah, that's what's so interesting about TransOcean's position right now. A lot of their competitors are worried sick about those potential gaps in their schedules for 2025. Everyone's calling it the white space, right? But TransOcean, it seems like they've completely sidestepped that issue. Some seriously strategic contracting going on there.
So while everyone else is scrambling, TransOcean is already playing chess.
Looks that way, doesn't it? And they're not resting on their laurels either. They're already working on deals for 2026 and beyond. Negotiations are ongoing for projects in the Gulf of Mexico, Africa, Brazil, Norway, you name it.
Now, let's talk about their fleet. They're making a big deal about owning the only two 8th-generation drill ships in the world, the Deepwater Atlas and Deepwater Titan. On top of that, they've cornered the market on most of those high-demand 1,400 short-ton drill ships.
Yeah, if you're not familiar with those terms, an 8th-generation drill ship, that's the top of the line. We're talking about the most technologically advanced in the world, able to drill in crazy deep water, handle some of the harshest conditions imaginable. And that 1,400 short-ton capacity, that speaks to how robust these vessels are. TransOcean is clearly betting big on this asset quality is king strategy. And so far, the numbers are backing them up. These high-end rigs, they don't just attract the best contracts, they demand premium rates, which gives TransOcean a massive advantage over the competition.
But let's be real, it's not all sunshine and roses. There's been some talk about problems with the reliability of their blowout preventers, or BOPs, which obviously affects how much time they can spend actually drilling and making money.
Right. They've admitted to some teething problems with their new 20,000 PSI blowout preventers. I mean, these are incredibly complex pieces of equipment. So it's not entirely unexpected that there'd be some growing pains with this new technology. But it is something to watch, for sure. How quickly can they fix these issues, and how's this whole situation going to impact investor confidence? That's the big question everyone's asking.
Now, for the elephant in the room, or maybe the whale in the deep water, I guess you could say, there are persistent rumors about a potential merger between TransOcean and Seadrill.
Yeah, the consolidation conundrum, as some are calling it. Now, Thigpen didn't say much about it specifically during the earnings call, but he did spend a lot of time talking about how consolidation could be a good thing for the industry as a whole. He mentioned things like cost savings, a wider market presence, and the potential for even better service quality.
So it sounds like they're not ruling it out, but they're not jumping in headfirst either. It's got to be the right deal, right? I mean, after all, just getting bigger doesn't guarantee success.
Exactly. Any merger would have to make strategic sense, especially for a company like TransOcean, which is already in a pretty enviable position.
Speaking of smart moves, TransOcean seems really focused on getting their debt under control. They've said publicly that their goal is to hit a net debt-to-EBITDA ratio of less than 3.5 times by the end of 2026.
Yeah, and that target is actually a make-or-break condition for them to even consider returning cash to shareholders. So hitting that ratio is a big deal. Shows they're serious about building a strong financial foundation for the long term. And for investors who stuck with TransOcean through the ups and downs, well, it could mean some nice rewards down the line.
But here's what's really puzzling. Even with all this positive performance and a pretty optimistic outlook for the next few years, TransOcean stock has taken a hit, down 35% since the start of the year. How do we make sense of that?
Well, that's the million-dollar question, isn't it? To really understand this, we need to go deeper than just the headlines. We need to understand the nuances of TransOcean's strategy. They've been very vocal about prioritizing those long-term contracts, which acts as a buffer against the short-term ups and downs of oil prices.
So it's like a safety net. Even if oil prices drop, TransOcean still has that guaranteed income stream locked in.
Exactly. And don't forget, deepwater projects, they generally have much longer lifespans than those in shallower waters. Once a company invests the massive amount of capital it takes to get a deepwater well up and running, they're not going to shut it down just because oil prices take a temporary dip.
Makes sense that they'd want to ride out those dips, especially when we're talking about the high-return projects you find in deepwater drilling.
Right. And let's not forget who TransOcean's main customers are. We're talking about the oil and gas super majors. Companies with deep pockets and a vested interest in maintaining steady, long-term production.
So not exactly fly-by-night operations that panic at the first sign of trouble. These are the heavy hitters, the ones playing the long game.
Exactly. They understand that this industry is cyclical, and they're prepared to weather the storms.
But even with those long-term contracts and that super stable customer base, wouldn't a prolonged drop in oil prices still hurt TransOcean's bottom line?
It's a valid concern. If you look at their financials, they're still carrying a lot of debt, and those interest payments are definitely eating into their profits.
So if oil prices stay low for a long time, it could slow down their plans to pay down that debt.
It's possible, and it could also impact their ability to reinvest in the fleet or buy back shares, which is something they've said they want to do down the line.
So where does that leave investors? Time to panic and jump ship.
I wouldn't go that far. This is where we need to think critically and weigh all the different factors. TrainMotion is a well-managed company with a solid track record and a smart strategy. They've positioned themselves to thrive in this current upswing, and they're clearly taking steps to mitigate the risks of future downturns.
But that oil price uncertainty is still hanging over everything, right?
Absolutely. It's the inherent risk of investing in this sector. You can't predict the future of oil prices with any certainty.
Okay, so for our listeners who are following this TransOcean story, what are the key things they should be watching for as this all unfolds?
I think the main thing is their execution. Can they deliver on those long-term contracts? Can they maintain those high utilization rates? And how well can they manage their debt as interest rates keep climbing? These are the real indicators of their operational strength.
And of course, keep an eye on oil prices.
Always. The energy market is like a wild animal. TransOcean's fate, like everyone else in this space, is tied to those unpredictable swings.
So basically, it's a wait-and-see game. Buckle up and see how it plays out.
In a way, yes. But it's not just about passively waiting. It's about understanding the fundamentals, the underlying forces driving this company and this industry. Being prepared for the opportunities and challenges that are bound to come up. That's the whole point of a deep dive, isn't it?
Couldn't have said it better myself. We're exploring the depths, uncovering the hidden complexities, and hopefully coming out of this with a much richer understanding of how this whole world works. In this case, the world of offshore drilling.
And hopefully you'll come away from this with some valuable insights that can help inform your own investment decisions.
Now, I want to circle back to that stock performance for a moment. Down 35% since the start of the year, even though the company seems to be putting out good news, it's a little baffling.
It is perplexing, isn't it? Makes you wonder, is the market missing something? Are investors overreacting? Or is this a sign that something's brewing beneath the surface? A downturn that TransOcean's management isn't fully acknowledging.
So we've got this tension between the company's narrative of strength and stability and the market's apparent skepticism. What are some possible explanations for this disconnect?
One possibility is that investors are too focused on the short term. They see the potential for oil prices to be volatile, and they react accordingly, without fully grasping the significance of those long-term contracts and those customer commitments that form the bedrock of TransOcean's business.
So they're so focused on the waves that they're missing the deeper currents driving the ship.
That's a great analogy. Another possibility is that there's just not enough clarity about how TransOcean plans to navigate the energy transition. Their expertise is in deepwater drilling for oil and gas, right? But there's no question that the long-term future of fossil fuels is facing some serious headwinds, from renewable energy and changing global policies.
Yeah, it's a legitimate concern. Even if TransOcean is doing great in the current market, investors are probably wondering, okay, but what's your plan for a world where oil demand starts to decline?
Right, and it's a question that TransOcean needs to answer convincingly if they want to reassure the market and close that gap between how well they're doing operationally and how their stock is being valued.
So they need to paint a clear picture of the future, one that addresses the energy transition head-on and shows how they plan to stay relevant and profitable in a world that's moving away from fossil fuels.
Exactly, because if they don't, that market skepticism is likely to stick around, no matter how impressive their earnings reports might be.
It's a classic case of perception versus reality. And right now, it seems like perception is lagging behind.
It really is. And that's why it's so important for investors to go beyond the surface, to dig into the company's strategy, scrutinize their financials, and really understand the broader industry trends that are going to shape their future.
It's about connecting the dots, understanding how all these different forces interact, and ultimately making informed decisions based on a comprehensive view of the entire landscape.
And that, my friend, is what the deep dive is all about.
Well said. Now, I want to shift gears a bit and talk about something we touched on earlier, the whole consolidation question. Let's dive a little deeper into these rumors about a potential TransOcean Seadrill merger.
What makes this particular merger so interesting is that it would bring together two of the absolute powerhouses in the offshore drilling space.
A real power couple of the deepwater world.
Precisely. And it would create a giant with a truly global reach, an unmatched fleet, serious market power.
But as we discussed earlier, bigger isn't always better. What are some of the potential downsides to a mega merger like this?
Well, one obvious concern is regulatory scrutiny. Antitrust authorities are definitely going to take a hard look at a deal of this size to make sure it doesn't stifle competition in the offshore drilling market.
So there's a chance the deal could be blocked, or they might have to make some major concessions to appease regulators.
Exactly. Another potential challenge is integration. Combining two large, complex organizations, each with its own culture and way of doing things, can be a very difficult and time-consuming process.
It's not as simple as just merging two fleets of ships, right? You've got all these human factors to consider, potential redundancies to address, and a whole lot of internal politics to navigate.
Precisely. A successful merger requires careful planning, clear communication, and strong leadership to ensure a smooth transition and to minimize disruptions to operations.
So while the potential benefits of a TransOcean Seadrill merger are clear, greater scale, cost savings, market dominance, there are some significant hurdles to overcome as well.
Absolutely. It's a good reminder that mergers and acquisitions are complex undertakings, and the outcome is never guaranteed.
So we'll have to wait and see how this particular saga unfolds. But one thing is certain, the offshore drilling landscape is in a state of flux, and consolidation is likely to play a major role in shaping its future.
I agree. And it's something investors need to be aware of when they're evaluating companies in this space. The dynamics of competition, pricing power, and access to capital, they're all likely to be affected by this wave of consolidation that's sweeping the industry.
It just goes to show that investing is about more than just looking at a company's individual performance. You need to understand the broader industry context and the forces that are shaping the playing field.
Exactly, and that's where our deep dive approach comes in. By really getting into the details, connecting the dots, and exploring all the different angles, we can develop a much more nuanced understanding of the opportunities and risks that lie ahead.
Now, before we wrap up our exploration of TransOcean, I think it's important to zoom out a bit and consider the bigger picture.
The macro view. It's always crucial to remember that TransOcean, like all companies in the oil and gas sector, operates within this incredibly complex and constantly evolving global ecosystem.
So it's not enough to just analyze their financials and strategy in a vacuum. We have to take into account all these geopolitical factors, the energy transition trends, and the overall economic outlook. All of these things can have a huge impact on their business.
Exactly, for example, the war in Ukraine and the resulting energy crisis in Europe. They've had a ripple effect on energy markets worldwide, influencing oil prices, demand projections, and investment decisions across the entire industry.
So even though TransOcean's focus is on deepwater drilling, they're not immune to these global events. And the shifting dynamics of the energy market.
Absolutely not. And that's why it's so important for investors to stay informed about the wider geopolitical landscape and how it might impact the companies they're investing in.
Now let's talk about the energy transition. It's a topic that's generating a lot of buzz these days, and for good reason. The world is making a serious push to move away from fossil fuels and towards renewable energy sources.
It's a massive shift, and it's raising some serious questions about the long-term viability of the oil and gas industry as a whole.
So where does a company like TransOcean fit into this evolving energy landscape?
That's the question everyone's asking. Their current business model is built on deepwater drilling for oil and gas. But they're not blind to what's happening. They're exploring opportunities in emerging sectors like offshore wind energy.
So they're not just sitting back and waiting for the world to change around them. They're actively looking for ways to adapt and stay relevant in the face of the energy transition.
Exactly, and it's a smart move. To survive and thrive in the long run, they need to diversify their offerings, leverage their expertise in offshore operations, and position themselves as a key player in the broader energy ecosystem.
So it's not just about drilling for oil anymore. It's about becoming an all-encompassing energy solutions provider.
Precisely. And that requires vision, adaptability, and a willingness to embrace new technologies and business model.
It's a tall order, but if any company can navigate these choppy waters, it's a company like TransOcean, with its proven track record, strong management team, and commitment to innovation.
I agree, but it's going to be a fascinating journey to watch. The energy transition is complex and multifaceted, and there will undoubtedly be winners and losers along the way.
So as investors, we need to stay informed, think critically, and be prepared for all the twists and turns that are bound to come up.
Well said. And that brings us to the final factor we need to consider, the broader economic outlook.
The big picture: inflation, interest rates, the possibility of a recession. These macroeconomic forces can have a huge impact on any industry. And the oil and gas sector is no exception.
Exactly. Higher interest rates increase borrowing costs for companies like TransOcean, making it more expensive to finance new projects or refinance existing debt.
And if a recession hits, it could dampen demand for oil and gas, putting downward pressure on prices and potentially impacting TransOcean's future earnings.
Precisely. These are all factors that investors need to carefully consider when they're assessing TransOcean's prospects and making informed decisions.
So it's about connecting the micro and the macro, understanding how the company's specific circumstances intersect with the broader economic environment.
Exactly. It's a holistic approach to investing, one that considers the company, the industry, and the world at large.
Because ultimately, it's all interconnected.
It certainly is, and that's what makes the world of investing so fascinating, challenging, and rewarding.
Well, let's bring it back to something we touched on earlier, the whole consolidation thing. Let's dig a bit deeper into those TransOcean Seadrill merger rumors.
All right, so what makes this merger so interesting is that, well, it would combine two of the biggest players in offshore drilling.
The power couple of deep water, you could say.
Exactly. You'd have a company with global reach, an unmatched fleet, serious market power.
But like we talked about before, bigger isn't always better, right? What are some of the downsides we should consider with a merger like this?
Well, one thing that comes to mind is regulatory scrutiny. Antitrust authorities are definitely going to scrutinize a deal this big. They'll want to make sure it doesn't hurt competition in the market.
So there's a chance the deal could be blocked. Or they might have to make some concessions to get it approved.
Exactly. And then there's the whole integration challenge, combining two massive organizations, each with their own culture, their own way of doing things. That can be a really tricky process. Takes time.
It's not just about merging two fleets of ships. There are all these human factors, right? Potential redundancies, internal politics, that sort of thing.
Precisely. A successful merger needs careful planning, clear communication. Strong leadership is key to ensure a smooth transition and to minimize disruptions to their operations.
So the potential benefits are there. Greater scale, cost savings, market dominance. But there are also some big hurdles to clear.
Absolutely. Mergers and acquisitions, they're complex, and the outcome is never guaranteed.
So we'll have to wait and see how it all plays out. But one thing's for sure, this offshore drilling landscape is changing fast. And consolidation is going to play a big part in shaping its future.
Definitely. And investors need to keep that in mind when they're looking at companies in this space. Competition, pricing power, access to capital, those are all things that are going to be affected by this wave of consolidation.
Goes to show, you can't just focus on a company's individual performance. You got to understand the bigger picture, the industry context.
Exactly. And that's what we try to do with these deep dives. We get into the details, connect the dots, explore all the angles. That's how we can get a better grasp of the opportunities and the risks.
All right, so before we wrap up on TransOcean, let's zoom out for a second. Let's talk about the bigger picture.
The macro view. Got to remember, TransOcean, like every company in oil and gas, they operate in a global ecosystem. And it's complex, constantly changing.
So we can't just look at their financials and strategy in isolation. We have to think about geopolitics, energy transition trends, the overall economic outlook. All those things can have a big impact on their business.
Right. For example, the war in Ukraine, The energy crisis in Europe, those have had ripple effects on energy markets everywhere. It's affected oil prices, demand projections, investment decisions across the entire industry.
So even though TransOcean is focused on deepwater drilling, they're not immune to these global events, these shifts in the energy market.
Not at all. Investors need to stay informed about what's happening globally and think about how it might affect the companies they're invested in.
Now, let's talk about the energy transition. There's a lot of buzz around that these days, and for good reason. The world is moving away from fossil fuels, moving towards renewable energy.
It's a huge shift, raises questions about the future of the oil and gas industry.
So where does TransOcean fit in?
That's the million-dollar question. Right now, their business is built on deepwater oil and gas. But they're not ignoring the trends. They're exploring things like offshore wind energy.
So they're not just waiting for the world to change around them. They're trying to adapt, stay relevant in the face of this energy transition.
Exactly. If they want to survive in the long run, they need to diversify, leverage their offshore expertise, position themselves as a key player in the broader energy ecosystem.
So it's not just about drilling for oil anymore. It's about becoming, an energy solutions provider.
Precisely. That takes vision, adaptability, willingness to embrace new technologies, new business models.
It's a tall order.
All right.
But if any company can handle it, maybe it's TransOcean. They've got the track record, the management team, the commitment to innovation.
I agree. It's going to be interesting to see how this all plays out. The energy transition is complex. There will be winners and losers.
So investors need to stay informed. Think critically, be prepared for whatever comes next.
Well said. And that brings us to the last factor we need to think about, the overall economic outlook.
The big picture. Inflation, interest rates, the possibility of a recession, those things can have a huge impact on any industry. Oil and gas is no exception.
Exactly. Higher interest rates mean higher borrowing costs for companies like TransOcean. Makes it harder to finance new projects, refinance debt.
And if we do hit a recession, demand for oil and gas could fall, put pressure on prices,
Yeah.
which could hurt TransOcean's earnings.
Exactly. Investors need to take all of this into account when they're evaluating TransOcean's prospects.
It's about connecting the dots, seeing how the company's situation fits in with the broader economic environment.
Right. It's a holistic approach to investing. You consider the company, the industry, the world.
Because it's all connected in the end.
It is. And that's what makes investing so fascinating, so challenging, so rewarding.
All right, so anyone listening who might be thinking about, buying TransOcean stock, or maybe you already own some and you're trying to figure all this out, what should we be keeping an eye on in the coming months, years, all that?
Well, first off, I'd say watch their contracting activity. Can they keep landing those long-term contracts at these amazing day rates? That's going to tell us a lot about whether they can keep this momentum going and whether they can handle any rough patches the market might throw at them.
So keep checking those press releases, see if they keep adding to that backlog.
Exactly. And pay attention to whether they can bridge that white space gap we talked about, that potential lull in 2026 and beyond. Are they signing new contracts that start right as others are ending? That's a good sign they're thinking ahead strategically.
Makes sense. What else should we watch for?
Those BOP reliability issues, remember those. See if they can get those sorted out quickly. Get back to those high utilization rates they're known for. Any downtime means lost revenue, right?
Right. A rig that's not drilling isn't making money.
Exactly. If those problems drag on, it could shake investor confidence. Also, keep an eye on their debt. How are they managing it? Are they making progress towards that debt to EBITDA target? Can they refinance their debt on good terms, even with interest rates going up?
So basically, are they walking the walk when it comes to reducing that debt?
Exactly. And finally, I'd say pay attention to how they're handling this energy transition. Are they taking real steps to diversify, to get ready for a future where oil and gas might not be the only game in town?
Because things are changing fast, right? You got to adapt.
Absolutely. The companies that can evolve, that can grab those new opportunities, those are the ones that'll succeed in the long run.
Well, there you have it, folks. TransOcean, a company at a crossroads, riding high right now, but facing some potential choppy seas ahead.
It's a really interesting case study. Shows you how this industry works, how cyclical it is, the energy transition, the whole perception versus reality thing in the market.
And as always, it's up to each investor to do their own homework, weigh the risks and rewards, make decisions based on their own goals, their own risk tolerance.
We hope this deep dive has given you some food for thought as you navigate the world of investing.
Thanks for joining us on the Deep Dive. Until next time, keep exploring, keep learning, keep asking those tough questions. That's how we understand the world, how we make sense of it all. The opportunities, the challenges, all of it.